Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast with Mark Pearson, and Chuck is back on the show today. They made up a new word, and if you have been listening to this show for the time that we've been doing it, Mark and I make up words a lot. Now, I actually make up a lot more words than Mark did, but he made this one up this time, and the word is Fin-ergy, and that's what we're going to talk about today. Mr. Pearson, what the heck is Fin-ergy, man?
Well, for full disclosure purposes, I don't know if we've made that word up or not. Did we, Chuck? I mean, I don't know if I've heard that on CNBC or not.
It's been floating around, but I think we're actually bringing it to the forefront. Let's take credit for that.
We're going to take full credit for this.
Partial credit, three quarters maybe.
Beautiful. Well, Fin-ergy. Well, first of all, Matt, always good to be with you on the big show. I've missed you since the last time I was on with you. So it's good to see you. And secondly, Chuck, always good to have you back with us on the show.
Thank you, sir.
And Fin-ergy is the combination of finance and energy, two of the top investment sectors in a rising inflationary interest rate environment. What do you say to that, Sir Chuck?
Well, I'm amazed again, just by, we talk about this 2 or 3 times, I think, on every podcast, process before progress, right? And I think in this one, we're going to love to go back in time, right, and speak about how the process unearthed financials and energy when no one wanted to touch those with a 10-foot pole, right? We're talking late 2020, right, when justifiably concerned about the virus, but people weren't traveling and they weren't going to their local bank to borrow money. And those were down and out as businesses. And I'm going to love to hear about how you, and certainly our team, unearth these, what I'll call nuggets of gold today, which are leading in a misery storm of downdraft in the indexes.
Right. Well, there's a couple things I want to, so great points. And you teed it up as usual really well. Here is, as I came to the committee, I'm going to say probably in summer of 2020, maybe the fall, talking about the fact that COVID was going to create some short-term inflation, but it was also going to cause some long-term inflation. Here's why. I mean, hindsight's always 2020. And for full disclosure, I've been wrong short-term plenty of times about stuff. But in this particular scenario, to me, it seemed, you guys, that the market or the valuations that investors were giving businesses was very similar to the mid to late 1990s. And frankly, what I find interesting is there was a lot of similarities in the mid to late 90s with 2019, 2020, 2021, in that there was a lot of discussion about buying index funds, buy the indexes. And I'm probably going to get these stats wrong, but in general, if I remember correctly, in 1999, 86% of the total S&P's return that year, which I think was around 28%, if I remember right. Does that sound right, Chuck?
It was in 1999. I think you hit it right. And it was between 25. It was less than 30, but more than 25. Let's call it 28.
And 86% of the return that year came from the top 10 S&P 500 stocks.
That's
this
correct.
Is another proponent of why I'm not a fan of indexing. People, when you don't know what you own, you don't know what risks there are to your portfolio, what businesses you own, it's all fun and games and it's all smoking and joking until it isn't anymore. And when you're in an environment that's rising interest rates and Fed tightening, meaning money is going to come out of the supply to the markets, your smart money is going to get smarter about where they put their money.
Exactly.
And what I think I started seeing happening in mid to late 2020 was the jabberwocking going on, and in the financial circles was, we're rating our value of companies on price to sales.
Got it.
Well, you can have lots of stinking sales in your business and make no money. But if you don't make money, you don't keep your doors open. So at some point, the euphoria has to end. And you can talk all day long about the future growth rate, the future of these businesses. Yeah, great. But one of the examples I love to give is the Walmart example. Here's a company that literally in the mid 90s up until 2000, the stock was trading at an average, I believe, somewhere in the 40s.
It was
times earnings.
Yes.
Yeah. And from 2000 to basically, I don't know, 2015, 16, 17, I don't remember. I'd have to look at a chart because I'm doing this off my head. But from a performance standpoint, the stock did nothing. And you could say it was a great company, but the problem was you had what you are having today, which is the deceleration of the price to earnings ratio and the price to sales ratio. And while Walmart's stock was flat, was not doing great, their earnings were actually going up. The company was making more and more money. So it really boils down to this idea of what are people willing to pay for the earnings of a company or the sales of a company. The more money in the system, the more, let's call it, froth that can build. And I thought that after COVID, when oil was trading at a negative number, which I thought I could just say there's no stinking way that anyone was going to tolerate oil at a negative price per barrel for very long.
No.
And interest rates were at 0.5 on the 10-year, that, it eventually has to end. And I'm always going to be wrong about when something like that happens, but I'm not going to be wrong if, because the financial system just doesn't operate that way. Now, when it comes to Nepsis, and it comes to this idea of knowing what you own and why you own it and investing with clarity, I felt late 2020, it was time to start making a much bigger macro shift. And I had buddies razzing me in 2021, I believe, 2020 or 2021. They were laughing at me for selling Square. And I sold Square at like 170, 180, we got out of it. And it went to like 280, 290. And my buddies were laughing at me. And I said, look, pigs get fat, hogs get slaughtered.
Great saying.
And today, Square, now Block, is trading at $132 a share. Same thing happened with Appian. We sold our Appian position at 125, I think it was, 130, went to 200. My buddy, we always talk stocks and shop. They're laughing at me. And I'm like, sorry, I'm not. Listen, we've made lots of money for our clients in these companies. I'm not going to sit there and continue to try to guess when the bubble's going to burst. Appian today trades at $53 a share. It doesn't mean these aren't good companies. What matters is you have to understand how to value an asset in any given season of investing, and seasons change in investing. And the season is changing once again. Indexing, is going out the door. Active management is going to become more prominent once again. Paying for real earnings, paying for a dividend, paying for a great business that's growing the dividend and growing their earnings is going to be what's going to happen, because the inflation, well, for a long time, people thought was transitory. I'm sorry. If you got a bunch of people locked in their houses for a long time and they finally get out, as they use the old phrase, the horses are out of the barn. And when the horses are out of the barn, they're going to run and they're going to spend money. They're going to live life. And you're already seeing it in the bottlenecks in the supply chain. Cars are selling at unbelievable values. You can't get components for cars. You can't get other products and services. That is going to, supply and demand will ultimately cause an inflationary environment. And that's what we have happening. Yeah. All right. I got a little bit on my soapbox there. Sorry, guys.
No, you did excellent. I took some mental notes because I wanted to just add some context to what you said, Mark, which was superb. So let's talk a little bit. We'll get a little bit wonky if it's okay with you. And I promise you I won't go down the rabbit hole, but you mentioned valuation. One of the great things I think that you've been saying for the 2 decades I've known you is PE ratios are relative. So which may be unravel that, because I'd love our listeners to understand. You mentioned the price you're going to pay for future earnings. That's all the simple PE ratio is, right? So
Right.
you ask yourself, right, and you want to buy a business. So I want to just pass this back to you. So here we sit where, and we're going to always own technology, but broadly speaking, the technology sector, is at 92% of its historic average price earnings ratio. What does that tell you? That we're getting closer to, right, a top,
Yes.
broadly speaking. But energy, think about this, is at 63%. Financials are at 54. They're two of the three on the bottom. What would that suggest to you, just using one simple metric, as to how long a tail could be for good businesses in these sectors?
Well, in statistical measurement, and I always have viewed our portfolio management in a statistical manner, meaning statistical probabilities of success or failure in any given business. And there's lots of metrics that you use in that process.
Yeah.
But it would stand to reason that in the field of statistics, generally speaking, most of the time, there's usually a reversion to the mean.
Exactly.
Right? And so at some point, you're going to get a reversion to the mean. This is why I believe it's so important to have a sell discipline when you own businesses. Profits are always great and people want to, make money. Problem with most people is they don't really own individual businesses. They own mutual funds or exchange traded funds. So they don't know what businesses they really own in their portfolio. And quite frankly, most people probably don't even know the value. Now they rely on their financial advisor to do that. And while a lot of financial advisors probably pay it somewhat of attention to that, the reality is that a lot of financial advisors don't know what's in those ETFs that they own either, unless they're doing a lot of research on that. And that's not to say there are not firms out there that don't do that. What I am trying to say, though, is that there are macro shifts that happen in the economy and the markets, and there are micro shifts. There are top-down, statistically speaking, shifts and bottom measurements. And I'm going to be wrong 100% of the time on when I decide to buy or sell a company. But there is going to be an overarching theme to the process that we use in the measurements we use for the businesses that we want to own, which we talked a little bit about in our investment strategy. When you're tightening money supply, they're going to raise interest rates. They're taking money out of the system. The more money that comes out of the system, the less money there is for people to take on risk assets. The less money there is to take on risk assets, I hate to tell you, you are going to have a shrinkage of the valuation metrics that people are going to use to invest in the businesses they want to own. This is not rocket science. I never could have been a rocket scientist. This is just common sense. And so you're seeing that happen quickly as we're doing this podcast, Chuck and Matt. Year to date, right now, the S&P is down 4.62%. The NASDAQ is down, call it almost double at 8.18%. The ACWI is down 3.57, and the Dow Jones is down 3.45. You could say this is a classic correction, but this is not a classic correction, in my opinion. I think this is repricing of assets. If you're going to take money out of the system and you can't have access to capital to invest, you are going to see these things happen. And, this thing happened in 1999, and people will come out and they'll swear by the value of these great companies that have huge valuation metrics. And you can talk all you want, but at the end of the day, it is still all about what I call relative value. This is why PE ratios are relative. What is money willing to pay to invest in a business? And I think what you're seeing is the beginning stages of that happen. We'll get a nice bounce back here. I'm sure we'll get a bounce back. We'll see some of these companies do really well. But there is a phrase, and it probably is the most accurate phrase to how I view investing and always have, and that is growth at a reasonable price. I'll pay for growth at a reasonable price. If you're not making any money, the value of that goes down. Doesn't mean it's not a good company. Doesn't mean the stock's not going to go up short-term or long-term. But there has to be a statistical measurement about how you're going to pay for that asset and how it blends into the rest of your portfolio allocation.
Spot on, my friend. You mentioned a couple of nuggets there I'd love to unearth. You mentioned one certainly about relative value. Maybe we can pivot a little to relationships. And I think you spoke to two of those, right? Rising interest rates and then certainly inflation. So let's hit the rising interest rates one first. And here's what I'd like to do if it's okay. Think about how, in essence, rates rise, right? So the Federal Reserve, right? They have a committee. We call it the Federal Open Market Committee, 18 members, not all vote, but they determine the overnight lending rate for banks, right? And every rate is based off of that. So if we tell our listeners, hey, rates are going to rise, and here's what I want to pass back to why we love financials here. If rates are going to rise, I want everyone to think about this. When the Fed announces that rate hike, Mark, every bank in the country in a nanosecond, with a snap of the fingers, sends out a wire, hey, we're raising our prime lending rate, and every other rate goes up off of that. But do they call you and I and say, oh, by the way, Mr. and Ms. Depositor, we're going to increase your savings rate or your CD? They don't do that. There's a massive float. No. Talk about that and why that's such a boon and a tailwind to financials when rates go up.
Well, there's a couple of things. First of all, with any asset class, and this is just my opinion, whether this is factual or not, I don't know. But I think in any asset class, there's expansion and there's contraction in value. And generally speaking, when you get the expansion, it overexpands. And when it contracts, it overcontracts. However, in the contraction phase, you never go back to the bottom. In other words, I think in the next 3 years, you probably will not see negotiating to buy a car. You're going to go to a car lot and the car lot's going to say, this is the price. And guess what the price is going to be? The retail sticker price. Because cars are selling above sticker price right now. And so there's a lot of behavioral components behind marketing and what companies charge. It's the same thing in the financial services business. As interest rates go up, that means the cost of borrowing goes up. Someone needs to tell me how that's not inflationary. You know, some people still insist that this inflationary rate's short term. Here's what I know is a fact. This is a fact. You and I are in our fifth. I remember when my parents bought a house and locked in an interest rate. I believe it was at 15%.
Yep.
They were as high as 18%. And they came all the way down where people were buying mortgages in 2%, 2.5%, whatever it was. My point is that the baby boomer generation and the generations below us have never lived really in a super low interest rate environment. They've only lived in higher, and the spigot has been turned on for so long. Interest rates have gotten so low that there will be a reversion to the mean. I don't know when that'll happen, but we haven't owned bonds really for, I'm going to call it 7 years. And there's just better assets to own on a risk adjusted basis. So when you look at the financials who are trading at historically low price to earnings ratios and low price to book ratios, if you sold everything, I think Citigroup is worth $85 a share. It trades at $65 a share. This is not a solicitation to go buy Citigroup. We own Citigroup. I'm just saying that metrics get out of whack during periods of market expansion and contraction. And the financial, as interest rates go up, should benefit. There's always execution risk, meaning the banks have to run their businesses accordingly. But at the end of the day, financials stand to gain tremendously, as will energy.
Excellent. I want to just pivot to energy, like what we just spoke to, and valuation. And I remember back, and again, not a solicitation recommendation to buy this company, but you've spoken about it on numerous podcasts, Fin-ergy. I'll never forget when you brought it to the committee, we all voted yes. And then you spoke actually to the advisor group. This was 18 months ago. And you're getting a lot of riff about back then we had apparently an oil glut. And you said, no, we don't. And that once demand picks up, it's going to overreach the growth of supply, which has now been minimized. Talk about that dynamic. And you said oil, and we don't know what the price is going to go to, but here we're in the mid 80s. And I want you to speak about that part of the process, if you would, how you unearthed a business like Devon and why that even came up in the process, first of all, for our listeners. I think that would be really prudent.
Well, from the standpoint of Devon historically has been known to be a very well energy company. And so when you invest in businesses, you always want to own the well-run companies. Devon's always been well-run. We owned Devon. So we owned energy from, call it, early mid 2000s until 2015. When the financial crisis happened, we had energy companies that we wanted to hold on to. So we actually hedged our oil positions while oil went from 150 down to 70. That's how we are. That's hard for people to remember that 12 years ago, a barrel of oil was at $70 and they were producing a lot more oil. And the problem is, or not the problem, one of the big fundamental shifts in energy is oil companies are not like they were in the 2000s, where they were rushing to create more production to help offset the supply problem. Oil companies now are very vocal about saying, and particularly because there's a bigger macro thing going on here, which is the clean energy, EV vehicles. But that just doesn't happen overnight. You just can't snap your fingers and everybody's going to drive an electric vehicle. There's still going to be a need for fossil fuels for a long time to come. And energy companies, probably, if I was sitting in the boardroom with them, I would say he's going up right now. We could drill oil for $30 a barrel. It's at 80 right now. But the problem is you got capital costs to do that. And eventually oil demand will go down as more EV vehicles hit the market. Now that's a 10-year thought process. So oil companies have come out and said, we're not going to drill anymore. Our number one goal is to bring capital, to return capital back to our shareholders.
You got it.
As energy companies have demand issues, they're not going to go drill supply to bring down the price. The price is only going to go up, because the demand isn't going to go away until you get to a point where people say, geez, I can't afford this $4 gas. Here's what's interesting. Gas is almost $4 here where I am right now. Gas was $4 when oil was at $150 a barrel.
Got it.
I mean, at this point, oil is trailing the price of a barrel. Oil companies are trailing the value of what it costs. I mean, we got oil at 82 and we're paying $4. In 2007, it was $4 and oil was 130, 140. So you throw in the fact that they're not going to drill more, that's going to be an inflationary problem. I think energy is a huge investment at this point. And, Devon Energy on a valuation basis, number one, they've got a nice dividend yield. I think the last run rate I saw was about 7%. I don't think the market's caught up to it yet. Their dividend last quarter was massive. I think the forward price earnings ratio in Devon is 7 or 8 times, but there's a lot of other really good oil companies in the same boat. So, not all energy companies are alike.
Exactly.
And Devon hit a 52-week high this morning at just under $52 a share. So this is not a solicitation to go buy Devon Energy, but I would say that as you allocate your portfolio, you are going to want to allocate it in a manner that is going to get back to the basics: stock picking, price to earnings ratios, PEG ratios, dividend yields, return on assets, those kinds of things.
I love something you said, and I want to just unearth this, I think, as our last component of this podcast. You said return capital to shareholders. And I'd like you to talk a little bit about that. That's something Warren Buffett has always focused on. You mentioned your fundamental factors. There's one called return on equity. Talk a little bit about the way in which a business return capital to shareholders, and why is that so appealing to a business owner?
Well, there's two things. Of course, the number one biggest thing is dividends. And there's been lots of studies done on how much dividends add to a total portfolio's value. Depending on the report you read, some say anywhere between 40 to 60% of total stock market returns historically have come with dividends. And so dividends, whatever the number is, I don't care if it's 30%, statistically speaking, that's a big number.
Yes.
And you particularly want to look at dividend companies where they're growing their earnings, where they have pricing power. As inflation goes up, guess what? The cost of food goes up. The cost of fuel goes up. The cost of insurance goes up. Everything goes up in these asset classes. So while interest rates are going up and a 4% dividend yield may not seem that attractive to you, the reality is that as inflation grows and as cost of goods and services go up, those dividends are going to be able to go up with it. I mean, I remember back in the 80s, dividend yields in the 6, 7, 8% range for really good conservative blue chip companies. And people have spent so much time trying to chase yield now that those asset classes can become risky at the same time. So I do think that dividends play a critical component. The other area that has brought a lot of value to businesses for shareholders is stock repurchasing.
Exactly.
Companies will buy back their stock because they view it as number one, cheap. And number two is they buy back their stock. That means there's less stock out there, which means their earnings per share goes up, which means that if you use the price to earnings ratio, the value of that stock should go up at the same time. So I do think we're going to see more of dividends. I think particularly in the energy space, I think you're going to see that in a lot of different, what I refer to as the kind of stocks grandma and grandpa like to own, so to speak.
I love what you said there, in that combination of dividends and growing the dividends. It's why an individual in a rising rate environment isn't going to go out and buy a whole set of utility operators that are paying out all their earnings already in dividends, right? You want to own the dividend growing business is what you just, I think, unearthed. And I think that's so huge for our listeners to understand. If you got inflation at 7% and a company's growing their dividend 10%, just right, that math would suggest, hey, look, I'm kind of ahead of the game just there.
Right. 30% delta on that. And then to throw in volatility, I think volatility is going to become more important to the extent that when you see high quality companies going down during these periods, I look at companies, it's all public information, CVS, AIG, Cigna, Citigroup, Devon. These companies all have really good dividends, and the volatility is going to become less and in terms of the swings in price. And so it's going to become more prudent. You're going to have to be a little bit more active, that when you see a 5 or 10% pullback on a company like that, you want to go buy it. And a lot of these NASDAQ stocks have pulled back 40, 50, 60, 70%. I have zero interest in buying them. It doesn't mean we're not going to get a bounce out of them. I guarantee you're going to get a bounce. And I will guarantee you that some of them will survive and others won't. And we own technology and we own businesses that are as part of what I would call the more recent valuation metrics that have been used. But in my opinion, I really think we're going to get back to the basics here more than ever before.
Fantastic commentary, Mark. And I tell you, this has been one of my favorite podcasts to do with you, because here we are talking in the midst of what is a storm to so many investors on a day, right, when the Dow's down 500 plus and people are scrambling to understand what they own and why they own it. And I want to go back just one thing. I'll wrap this up here. The story that you had with talking to your friends, right, about Block, right, and Appian, and they laughing at you. The laughing was emotion. And you basically said our sell discipline says we're going to exit. It may not be at the top, right, but we're going to exit now. And why don't we end on that note there? I think that would be really good.
I think, in fact, I was texting with a friend this morning about that exact thing. And he made the comment about, he said he had read my 13F filings. And he said, it looks like you've got this portfolio already allocated for the future. And I said, yeah, we've been working on it for the last 12 to 18 months, because you can never guess the top and you can never guess the bottom. And so it is a marathon. It is a process over time in terms of how you allocate your portfolio. And sure, no, these growth stocks are getting hammered. And, as we speak right now, our clients are still up year to date. Now it's January, it's early. I'm not saying we're going to end up the year higher, but we are seeing already significant divergence between what's going on in the indexes and what's going on with our clients' businesses they own. Because at the end of the day, profits do matter.
All right,
what a great note to end on.
Yeah, that was freaking awesome. Fin-ergy, and it looks like we're going to have to hybridize a couple of other words, because you talked about a couple of other sectors that we have not talked about on the show. So you two need to prepare for that very, very soon.
All right, everybody. Homework?
I am totally giving you homework. Yeah. Because you made up a newish word, right? And now you need to somehow do some with some other of the sectors that you guys work with. And we should talk about those on the show.
Sounds like a plan, baby.
All right, brother. All right, everybody. If you're not subscribed to the podcast, make sure you do. And I'm sure you know somebody who needs to hear this. So please make sure you share the podcast. And if you don't mind, give us a quick review on iTunes or wherever you're listening. That helps people find the show so that they can know how to invest with clarity and know what they own and why they own it. So for Mark and Chuck, this is Matt. We'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC registered investment advisor.